It was American author Mark Twain who popularised the saying there are three kinds of lies: lies, damned lies, and statistics. I'm going to talk to you about one kind of investment statistic. It's called the total return. It's a very useful measure, but while it doesn't lie exactly, it doesn't always tell the whole truth either. I've come to the Greenwich Observatory because there's an astronomical link to the author of The Adventures of Tom Sawyer. Mark Twain was born during a visit of Halley's Comet in 1835, and he died the day after its next visit in 1910. Edmund Halley, the scientist after whom the comet was named, after he discovered it was the same piece of rock revisiting our skies every 75 years, worked here as Astronomer Royal in the 18th century. A gifted mathematician, Edmund Halley would probably have liked the idea of a total return. Total return adds together the two parts of any return from an investment. The first part is the capital return. This shows how much a share price or fund unit goes up or down. The second part is any income generated by the investment. Add the two together and you get the total return. We've already seen the impact that total returns can have in this series. When I looked at Standard Life, I showed how its investors had, on average, seen the value of their shares rise from £1,500 to around £2,500 over 7 years. That was just the capital return of the share price going up. In addition, investors received over £600 in dividends. Add that investment income and you've got the total return. In the case of Standard Life, because investors got their shares for free in the insurer's 2006 flotation, their overall return was more than £3,200. In fact, the total return goes a bit further than simply adding the capital and income together. It assumes that income or dividends are reinvested to buy more shares or units. The effect of this is extremely powerful over the long term, as this chart demonstrates. This shows the compounding effect of reinvesting dividends back into the stock market would have turned £100 into over £4,000 since the end of the Second World War. By contrast, £100 in cash would have merely doubled to £200 after inflation. So the total return is the investor's friend. Not only does it highlight the attractive returns from investing, it also helps you compare different types of investment. This page on the Citywire website shows the average total returns of funds in different sectors over the past 3 years. At a glance, you can see which areas have been more successful. That doesn't mean they will continue to do well, but it's a useful snapshot. If you looked at any of these sectors, you would be able to compare the funds inside them on the basis of which had generated the best total return. If you're investing in a unit trust or an open-ended investment company, you can get the total return by buying an accumulation unit in the fund. However, the total return is a bit like a telescope. It's great the way it lets you observe the overall picture. However, it can give a distorted view of what is really going on, particularly if you're an investor taking the income from a fund or share. When you're an income investor, you really need to take account of what's happening to your capital, because it's that money that will generate your income in future. Take these two top performing funds in the UK equity income sector. The top fund in the 10 years to the end of 2012 produced a total return of 209%. Magnificent. Just behind it was another well-known fund which produced a total return of 198%. Although their total returns are close, the way they achieved them is very different. Fund number 1 generated a higher income of 4.5% over the 10 years, while fund number 2 paid 3.3%. A higher proportion of the first fund's total return was an income, but less in capital. Over 10 years, you would have received a larger amount of income, but would have only seen your capital grow by 50%. This is partly because the fund was badly hit in the financial crisis. By contrast, fund number 2 more than doubled your capital while paying out a decent amount of income and doing better in 2008. Both funds are suitable if you know what you're getting into. It just goes to show that the total return is a helpful concept as far as it goes, but sometimes you need to look through both ends of a telescope to see what is going on.